Welcome back. You're watching Earnings Central here on CNBC-TV18. And to get into the fine print of the numbers that have come in from HDFC Bank and Kotak Mahindra Bank, we have with us a set of experts. Gurmeet Chadha of Complete Circle is with us. So is market expert Prakash Devan. Gurmeet, Prakash, thanks very much for your time here on CNBC-TV18. Gurmeet, starting with you, what did you make of the HDFC Bank numbers? It was a steady quarter, but of course, margins continue to decline.
I think sequential improvement, at least I'm concerned. One metric I'm tracking is the credit deposit ratio. That's down to now 99% from almost 106, 107. If you see, the fee income also is up. It's up almost at about 8140 crores. That's up almost 16-17%. And the ROA also is after some time closer to 2 now, almost 1.96, 1.97, if I'm not wrong. And they've used some contingent provisions also. And asset quality broadly stable. So I think what I'm looking is sequential improvement. I would have probably liked to see a little better NII and advances and deposit growth. But there is sequential improvement. And there is something which I think market will notice that, the merger blues, which was creating issues in terms of on most operating metrics, seems to be sequentially improving. And it's important for HDFC to do slightly better for overall markets to, recover from whatever little correction we've seen.
Well, absolutely. HDFC Bank is one heavyweight. Prakash, the credit deposit ratio is at actually a 5-quarter low. We've had total deposits for HDFC Bank grow by about 15%, advances at 7%. Of course, we'll have to see what the bank does on, the advances front, what kind of a portfolio sale, if at all, that is being reported they do. But what did you make of the numbers and how do you think markets are going to react to these come Monday?
So, Ritu, I do agree with Gurmeet. The credit deposit ratio was always a challenge, and it's an elephant that would take time to dance. But this set of numbers tell you that this is the first time, and especially when deposits, they've been working really hard on deposits, growing deposits, and that 25 trillion Q&Q improvement is definitely something the market will take cognizance of, because lending has never been a problem. And if you look at even the quality of assets, whatever recognition of NPAs and gross NPAs, net and gross both, they've been fairly in line with what other banks would have also kind of experienced, which means that they're not in a hurry to lend, but their focus on growing deposit has actually taken some positive results.
All right, Prakash. And Gurmeet, sorry to interrupt you, but we have the management of HDFC Bank addressing the media on this con call. So let's listen in.
That the recent GDP reported for the prior quarter was healthy at 6.7% growth. More important in that was to notice that the private consumption was showing a growth of 7.4% and exports showing a growth of 8.7%. Right. While the manufacturing PMI and services PMI moderated, yet they remained in the robust expansionary zone. RBI kept the rates unchanged at 6.5% in the October 24 policy meeting, but changed the stance to neutral with unchanged estimate of 4.5% for full year 25 inflation and GDP growth rate at 7.2%. Our house view is that the GDP growth rate could be around 6.8 to 7% for the financial year 25. More important that we keep a watch is any geopolitical risk, escalation that can rapidly change, impacting the supply chain and oil price, dampening the recovery in the consumption demand, which is very key to the domestic growth. Now, that's on the macro that existed and that we see developing. Getting into the quarter in terms of the advances under management as of end September at rupees 26.3 trillion, grew 0.6 trillion in the quarter and 2 trillion or 8% over prior year. Retail advances grew 338 billion in the quarter and 11.3% over prior year. CRB, our commercial and rural banking that drives our MSME and PSL book, grew 4.7% quarter on quarter, which is 380 billion, and rupees 380 billion, and 17.4% year on year. Wholesale segment degrew sequentially 2.8%. CD ratio as of September end stands at 99.8%. Now getting to the deposit side of the balance sheet, the deposits as of end September crossed the milestone of rupees 25 trillion even, grew by 1.2 trillion or 5% in the quarter and 3.3 trillion or 15% year on year. And similarly, the average deposits grew year on year by about 15.5%. Current account deposits at 2.8 trillion grew 3.1% in the quarter and 11.2% year on year. Savings account at rupees 6.1 trillion grew 2% quarter on quarter and 6.7% year on year. Our average CASA ratio is at 34.3%. Term deposits aggregated to 16.2 trillion as of end September and grew by 1 trillion or 6.7% during the quarter, where customers preferred a good amount of time deposit in this quarter given the rate scenario is at a peak. And it grew 2.61 trillion or 19.3% year on year. Our branch network stood at 9,092 branches. We added 241 branches in the quarter and 1,147 branches in the last 12 months. We added 2.1 million new customer liability relationships in the quarter, and we booked 1.7 million new cards in the quarter. Coming to the capital and liquidity, which remained pretty healthy, balance sheet remains resilient, LCR ratio at 128%, and total capital adequacy ratio at 19.8% and CET1 at 17.3%. On the revenues front, net revenues for the quarter were 416 billion. Net interest income, which is about 72% of total revenues, grew by 10%. The core net interest margin for the quarter was 3.46%, and on an interest earning asset basis, the NIM for the quarter was 3.65%. The total other income was 115 billion. Fees and commission income that constitutes 71% of the other income was at 81 billion and grew by 17% year on year. FX and derivatives income at 15 billion was higher 19% compared to prior year. Trading and mark-to-market were 3 billion gains for the quarter. Prior quarter was also close to that, about 2 billion. And the prior year, as you all know, was almost 10 billion gains we had. Excluding this transaction gains and mark-to-market income that I alluded to, total other income at 112 billion grew by 15% over prior year. Now getting to operating expenses for the quarter was 169 billion, an increase of 9.7% over prior year. The cost-to-income ratio for the quarter was at 40.6%. The GNPA ratio was at 1.36% compared to 1.33 in the prior quarter and 1.34 in the prior year. Out of the 1.36, about 18 basis points are standard. Thus, the core GNPA is at 1.18. However, these are included by us as in NPA as one of the other facilities of the borrower is in NPA. GNPA ratio excluding NPAs in agricultural segment was at 1.19%. Prior quarter was at 1.16 and prior year was at 1.20. The slippage ratio for the current quarter is at 31 basis point, about 78 billion rupees, as against 32 basis points in the prior quarter and similarly 32 basis points in the prior year. Now getting to the total provisions charge was around 27 billion rupees as against 26 billion rupees in the prior quarter and 29 billion rupees in the prior year. And getting to the total provisions comprising specific floating contingent and general provisions were about 177% of gross non-performing loans. These are in addition to security held as collateral in several of the cases. Floating contingent and general provisions alone were about 1.45% of the gross advances as of September end. Now, on a credit cost ratio basis, the annualized credit cost for the quarter ratio for the quarter was at 43 basis points. Prior year was 49 basis points, and prior quarter was 42 basis points. It is a very similar level. The total credit cost ratio net of recoveries was 29 basis points in the current quarter compared to 34 basis points in the prior year and 29 basis points in the prior quarter. Now, profit before tax was at 220 billion rupees. The net profit after tax for the quarter at 168 billion rupees grew on a reported basis 5.5%, and adjusted for the trading income and the mark-to-market income that I alluded to slightly earlier, and the tax credits that we booked in the prior year same time period grew by 17% over prior year. This has resulted in about 10% year-on-year average advances under management, 15% on the deposit side, and delivering a return on asset in the quarter of about 1.93% and return on equity about 14.7%. Earnings per share reported in the quarter is at 22 rupees 10 paise at a standalone bank level, and at a consolidated bank level, rupees 23.4. Book value per share on a standalone basis is rupees 604, and at a consolidated bank level is at 631 rupees. With that, Nirav, can I ask you to open up for questions, please?
Thank you very much. We'll now begin with the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, you are requested to kindly restrict to 2 questions per participant and kindly join the queue for a follow-up question. The first question is from the line of Piyush Shukla from the Indo Business Line. Please go ahead.
Good evening, sir. Thank you for taking my question. I have analysts have been tracking, sir, 2 key parameters, which is margin, which is stable in this quarter, and also the deposit mobilization, guidance that you would like to give. Deposits have outpaced credit for the second, multiple quarters now. So would it continue? Would the trend continue going ahead? And one final question I have is on the moderation in the wholesale loan book. What is the reason, sir? Is there a muted demand from corporates? And what is your guidance on wholesale side, sir? Thank you.
Okay, thank you for asking. Two important ones, which is on the deposit. But I wouldn't allude to an outlook as such or a forward-looking statement, but I would give you some context. Right, we are positioned with a little more than 9,000 branches, 9,092 to be precise, across more than 3,000 towns and cities in the country, working with 96 million customers and 207,000 strong people supporting the franchise. Our endeavor has always been to have that close connection and relationship with the customer to build the deposits, which is what you have seen. Our market share stands at about approximately 11%. Our distribution share is close to 6%. So we almost have 2x the distribution share in terms of the market share on the total deposits. On an incremental basis, historically what we have seen is that anywhere between 15 to 17, 15 to 18% on an incremental basis is what we have had the incremental share, which will give you about 50 to 70 basis points market share growth, which is what we have seen over a 3-year or a 5-year period. And that is the kind of a positioning that we have put the bank in to keep gaining this market share, and I will leave it at that rather than telling where it will go. Because quarter to quarter, the economic conditions can be slightly different, the available liquidity can be different, and there are some seasonalities that play out too, in the form of the current accounts that can be seasonal, the savings account that can be used for some festival or can be used for summer months, and there is an interest rate cycle that determines the propensity for customers to prefer time deposits and so on. So all of these play into that. So there is no one particular number or a target or a desire that we could have, except that what is available in the market, we have always tried to capture that share of growth that we have demonstrated in the past.
All right, so that was Srinivasan Vaidyanathan of HDFC Bank briefing the media on the second quarter numbers. A steady quarter from HDFC Bank for our viewers that are just tuning in. Advances growth of more than 15%, of about 7%, and deposits growth of more than 15% coming in for them. The credit deposit ratio, one of the key concerns, that's actually come down, but the street wants to see what further improvement we see from HDFC Bank on that front. On that note, we're going to wrap up this edition of Earnings Central. Thanks very much for tuning in. But stay with CNBC-TV18. More news and updates will continue on the other side of the break.